So now that the income statement is tackled, let's focus on the balance sheet. So the balance sheet, the financial position of the business or the partnership in this particular case. So it is basically the accounting equation. Assets equals owner's equity plus liabilities. So our assets, we know we have two main categories. We have the non-current assets, in other words, the assets that usually in our case are tangible, like your property or your land and buildings, equipment, vehicles. So it's usually things you can touch, tangible, T for touch, or fixed assets. So those assets we use to generate our income. And then we have financial assets. It will be like maybe a fixed deposit with a bank or an investment. Okay, so non-current means we will keeping them for long periods more than a year. Whereas current assets is the short-term ones. It's what we also refer to as our working capital, so we will convert it in cash within a period of a year. So there we have three main categories, namely inventories, trade and other receivables. So the inventories, okay, while I'm busy with this, let me just first go back to non-current assets. Let's tackle the notes. Okay, so note 3, so is our fixed asset tangible asset note. I've prepared a whole video for you on fixed assets, so I'm not going to focus too much into this one, but what I will say is the carrying value at the end of year, the total amount, that is what we will transfer to the notes, or rather from the note to the face of our balance sheet in here. Okay, then let's get back to the current assets. So we have three main categories, namely inventories, trade and other receivables, and cash equivalents. So now inventories, let's go to note 4. It consists out of our trading stock, usually according to the physical stock taking, and then also our adjustment for consumable stores on hand. That would be like maybe stationery. On the last day of the financial year, we count our stationery. We realize therefore that our expense for stationery is too high because it includes stationery we did not use. That stationery that we did not use become for one day an asset, namely part of inventories, namely consumable stores on hand. So we add trading stock and consumable stores on hand for a total, which we then again transfer to the face of the balance sheet for inventories. Trade and other receivables, so that is we mostly think debtors, people that owe us money on the short term, who we sell goods because we are selling goods on to them. So we have our debtors, our trade debtors, which is like debtors control, and then we will have to subtract the provision for bad debts, because we know historically all of our debtors will not pay us. So we use the prudence principle. We are conservative. We make provision for bad debts. So it's always in brackets. We subtract it to get what we call net trade debtors. And then we know at the end of the financial year we have some adjustments, like for example expenses, prepaid expenses, where we already paid for something that relates to next year. So for now something is owed to us, namely a service. That's why it's part of trade and other receivables. On the other hand, we have income accrued, also an adjustment that we made when there is still income that we should have received this year which we did not receive this year. So it is still owed to us, therefore it's again an asset. And then if you have deposits, it's also part of trade and other receivables. Example is for water and electricity. So we add up to the net trade debtors all these adjustments, we get the total, we transfer it again to the face, to trade and other receivables. And then finally we have cash and cash equivalents. So cash and cash equivalents, basically the word says it all. It's all the money that we have available, whether it's a fixed deposit, but remember we are focusing here on the current asset, so only that part that we will get back within 12 months. Then we could have a savings account, our normal bank account, and then we have cash float and petty cash. Cash float, again, just to refresh memory, it's basically what you have in your till available for change. Petty cash is used to buy small items for the partnership. So we add them all up, get the total, transfer again to the face of our balance sheet. So right in here, now we're at the position where we can add everything in the block for current assets and get the total on top. So we have the non-current assets total plus the current assets give us our total assets. So the left hand side of the accounting equation is done. Let's move on to the right hand side, which is owner's equity and liabilities, or equity and liabilities. So we have owner's equity, and as referred to earlier, for partnership, this is now different than for a sole trader. Sole trader, we only have capital. Now we have in addition the current accounts of the partners. We add them up to get the owner's equity.